Alright, so my mic. So this is the next video on the playlist for basic understanding of trading. Okay, this is basic, very basic. The first video I made was explaining the candlesticks. So now we're gonna go into what's called market structure. Okay, so I'm gonna type market structure. Okay, this market structure, this is what we're looking at. Okay, these three examples here are an example of market structure. Market structure is the definition of the movements, or I don't know, like the best way to explain this, like market structure is like a human, imagine a human body. So you have a human body, okay? And let's say the human body is the market. Market is like like a metaphor or whatever. The market structure is would be considered breathing for a human. So without market structure, there is no market. There is nothing, right? So there's three types of events that happen in the market according to market structure. So there's bearish market structure or bearish trend, which is a downwards momentum of price action. And then you have a bullish trend, which is an upward momentum of price action. And then you have consolidation, where the market moves sideways. It goes up and down, but there is no trend. You would just be losing money doing like trading in here. You would just be losing money. So as traders, we want to be trading during a trending market, which is these two. You want to be trading during a trending market. So when there's a trending market, there's money to be made. Okay? So we understand what market structure is. This is the market structure. This is the only thing that happens in market structure. These three things. There's nothing else that happens. It's either going up, it's either going down, or it's consolidating and it's going sideways. That's the only thing that can happen. Now let's go on to the next thing. So over here we have bearish structure, or you can call it a bearish trend. And then over here we have bullish structure, or you could call it a bullish trend. Okay? So you have to understand what makes a trend. What makes a trend? So if you see here, we have a high that's being made, we have a low, we have a lower high, and then we have a lower low. So this is the, I guess you can call it the characteristics of a bearish trend. So we have a high. Okay, this is a high. And then we have a low. And then we have a higher low. Or sorry, a lower high. Apologies. We have a lower high. And then over here we have a lower low. And then you have another lower high. Okay? For the bullish, we have a low. Okay? And then we have a high. And then we have a higher low. So instead of having a lower high, we have a higher low. So this low was the last low, and price did not come down and violate it. It didn't come down and violate it. it stayed up here above the low. Okay, and then you have a higher high, which is higher, is a high higher than the previous high. And then you have a higher low. That's a low which is higher than the previous low. So these are important things to understand. These are like the basic things that you need to identify the market structure. This is how you identify the market structure. Okay? So let me show you a quick example on a candle. Okay? Notice here, this is consolidation. We have a high, we have a lower, or we have a low, we have a lower high, and then we have a lower low. So this it was temporarily bearish, but then price came up and took out this high. Okay? So I wouldn't necessarily call this, like, this is consolidation. If you look at it like this is a consolidation. But if you scale down, you have bearish structure here. Notice you have a high, you have a high, and then over here you create a low. Okay, sorry, over here this is the lowest point, you create a low, and then you have a lower high right here, a lower high. So before I continue, I need to explain what a swing point is. You have to understand the swing points of the market. So these are just like, okay, so these lows, these highs, higher lows, higher highs, these are also called swing points. They're swings in the market. Okay, they're the peaks of the swing. So when you look at this whole move here, this is called a price swing. Okay, when you see this like that, this is called a retracement. Okay, so you have a price swing, and then it retraces, it swings again, and then it retraces. So a price swing is considered a move in the market that takes out a previous high or low. That's considered the swing. And once price comes down back into the area of the swing, it's called a retracement. So you see here, we have a swing that comes down. Over here we have a price swing, and then we have a retracement. We have a price swing again, and we have a retracement. Price swing, retracement. Okay? So you have to understand so now you understand the structure. What makes a structure is higher lows and higher highs creates a market structure. And now I just explained to you what a price swing is. And then I explained to you what a retracement is. Retracement. Okay? So these are the retracements. And then you have a price swing. Retracement, price swing. Okay? So once you identify the market trend, let's say we're looking at this. Okay? Forget this right now. Let's remove the bullish trend. Let's focus on the bearish trend. Okay? So once you identify the trend, you see this in the market. What you want to do is you want to be a seller, obviously. You don't want to be buying in a market that's trending bearish, right? So if you want the best, okay, so the best possible way, not possible, but I guess the most probable, let's talk about probability here, because this is what the trading is all about, right? So the best probability for a trade execution is to trade with the trend, okay? So you have to understand when you have a price swing like this, when you have a price swing, there's an area from the high to the low like this that offers liquidity, or it offers opportunities, okay? So when you have a bearish trend, you want to be selling anywhere above the price swing, which is called the premium. This is the premium. This is the top of the swing, and this is the bottom of a swing. Okay? And this is the discount. Okay? So when you want to take a short, or a sell like that, you want to be taking a short in the premium of a bearish price trend. Okay? When price action is trending bearish like this, you want to take shorts only in a premium. You don't want to take it below this 50% of this swing. Okay? If price comes down to here, it's still bearish. But you don't want to take a short. You wait for the next price swing. And if it offers it in an area where it's in a premium, like so, then you can take a short. Why? Why can't I take a short over here? Because according to when you look at risk to reward, it doesn't favor the trader. If you take a short here, because you're trading the price swing, so basically what you're doing is you're anticipating the next swing, right? So you know the price action is bearish. You have a swing here, a retracement, a swing here, a retracement, a swing here, a retracement. You want to be trading the swing. You want to take the next swing. So you see over here, price ends here, right? As a trader, I want to be looking to make money, not in the retracement, but after I notice that it comes to the 50% of this previous swing, then I can be like, all right, it's time to take a short to target the next low. This is the next low. These are the targets, okay? So you could take a trade like this. These are high probability trades, okay? So let's say you take a short, price comes up into the premium of this price swing, okay? And your target would be the next low, which is this. That will be your target, because you understand that a bearish structure creates lower lows, and it doesn't violate highs. It keeps the highs untouched like this. So if you take a short here, you can put your stop loss at this high, because you know that this is bearish. So price will not come up here. Just like over here. You take a short here, you put your stop loss here, or put your stop loss right here, and you take a short. Let's say this is 50%, like that. Okay. You take a short here, you put your stop loss on the previous high that was made, because the bearish structure, this shouldn't be violated. This is how you trade with this is called trading with the trend. This is the only way to trade, okay? Not the only way, but this is the most realistic way to trade and the most logical way to trade, okay? And then the same thing happens with the bullish structure. So if I have bullish structure, same thing happens, okay? So you have higher highs, or you have a low, a higher low, a higher high, a higher low, a higher high. So what you do is you want to wait for price after the swing. You want to wait for price to come down into a discount, okay? For here, you want to wait for it to come into a premium. But when it's bullish trend, you want to wait for it to come down to a discount. This is where you want to take a long. After you identify the structure, right? Like let's say there was more data. This is the data. You already seen this, okay? You already seen this. So you go like this. So there. Let's say price is here, and this is what we're looking at right now. You're like, okay, cool. So now we have this swing, and then now we have this swing. So you mark the low of the swing, and then you wait for price to come down into a discount, and then you say, okay, boom, I'm gonna enter my position long. Let's take it to the target, which is this level, because that's the next high, and this is a successful long trade execution. You put your stop loss at this low, and then you target the next high. This is trading with the trend. This is a bullish example. Okay? So, what dictates a swing high and a swing low? I should have said this first, but it's okay. It's all right. So, what dictates a swing high and a swing low? According to candles. I showed you a linear chart. Okay? Now I'm going to show you on the candle chart. What is a high? What is a low? So, a high or swing, swing high is this. When you have a high being made, and then you have a lower high here, and you have a lower high there, this makes the high. Okay? Notice here, you have three candles, okay? Three candles make the price swing. 1, 2, 3. 1, 2, 3. 1, 2, 3. So the three candles make the price swing. If you look here, we have a high. What makes this a high swing point? Well, you see this candle's high. It's on the left side. It's lower than this high. And then you have this candle lower than that high. So this is a swing. Okay, this is called a swing point. You see here, we have this low, and we have this low. This is not a swing. This is a trending. This is just a trend. Okay. If you come down here, you see price create this big swing point. You have a low, and on the left side you have a higher low. On the right side you have a higher low. So this is called the swing. Okay. This is the swing. This right here, you see this low and this low. This is not a price swing. This would not be considered a price swing because you have a lower low beside it and then you have a higher low. This right here is also a price swing. Okay? You have a low that's being made, and then you have a lower low on the left side, and you have a lower or a higher low on the right side. Okay? So this is a price swing. Let me get my brush. This is a price swing like that. This is a price swing like that. Okay? Because you have this low, and you have that low, this creates a swing. Now, also this. This is also a price swing. It's a minor price swing, but it's still a price swing. You have a high that's being made here. That's lower than this high. And then you have a high that's made on this candle, which is also lower than this high. So this is a price swing. So if you were to graph it out on a linear chart, it would look like this. It would look like this. So you have a high, a low, a high, and then you have another high like that. And then this is what it would look like if I were to draw it. A high, a low, a high, a low. See? This is the best way to explain it. I guess it'd be like this. Let me take my thing here. So we have a high, we have a low, we have a high, we have a low, we have a high, a low, a high, a low, like that. High, low, high, low, high, low. These are high lows, like that. And then you have consolidation. See? So price was bearish, and then it became bullish after. See? This is how you read it. This is what it looks like. So that's basically that's market structure for you right there. And hope you enjoyed that video. If you have any questions, just comment down below. And I'm gonna make my next video later explaining a more in-depth video on market structure. So stay tuned for the next video.